Welcome to the Maximize Business Value Podcast. This podcast is brought to you by Mastery Partners, where our mission is to equip business owners to maximize business value so they can transition their business on their terms. Our mission was born from the lessons we've learned from over 100 business transactions, which fuels our desire to share our experiences and wisdom so you can succeed. Now here's your host, CEO of Mastery Partners, Tom Bronson.
Hi, this is Tom Bronson, and welcome to Maximize Business Value, a podcast for business owners who are passionate about building long-term sustainable value in their businesses. In this episode, I'd like to welcome our guest, Susan Bryant, who is principal at the MB Group, a CPA firm based in North Texas. I met Susan a few months ago in a professional networking group called ProVisors. Now, let me just start out by telling you that not all CPAs are cut from the same cloth. Some are bookkeepers, some do taxes, and then there are some who really look at accounting as a calling to help their clients be better. They take a surrogate CFO approach in the businesses that they serve, and they are truly trusted advisors. That's how Susan and the MB Group work. Now, I network with a lot of CPAs because they are typically close to my prospect clients, so business owners. I explain what we do and offer my services to their clients who are thinking about transitioning their business. Susan is the first CPA who, after hearing what we do at Mastery Partners, said, "Oh my gosh, my clients really need your help." She really understands why every business owner needs to have a solid exit strategy. So welcome to Maximize Business Value, Susan. Tell us about MB Group.
Hi, Tom, and thanks so much for having me on the podcast today. So the MB Group is a certified public accounting firm. We're based out of Plano, Texas. We provide accounting services and tax services to business owners. And one of the things that really we focus on a lot is helping business owners to develop solid accounting policies and procedures so that they are getting timely information so that they can end up building their business more successfully. And then we take that information and all of those profits and we find and employ very strategic tax plans to reduce and minimize their taxes.
Minimize taxes. Gosh, no business owner wants to do that, do they?
Surprisingly, it's their number one complaint.
Yeah, exactly. So what is your background and why did you become a CPA?
Well, I am definitely a different kind of accountant. So I originally started off my career as an internal auditor with a degree in marketing. Everybody says, "Susan, how did you get into accounting?" So I started taking match. Right. So it's not every day you get a CPA who is a marketing major, but I really became a lover of accounting when I studied for the CPA exam, and I really learned about how powerful what it is that we can do for business owners. And so I started to work for a very, very small accounting firm in Denton, Texas, where it was me and two partners, and I basically got to learn and do everything. So I've done taxes and compilations and audits and reviews and tax preparation. I mean, you literally name it, I've done it. And so it was really there that I sort of understood maybe the holistic approach that needs to be taken when we start servicing clients. It's not just one thing we need to look at, it's so many things.
Taxes and accounting and audits. Oh my. I think we need to spend some extra time and maybe come up with a new tagline for MB Group, maybe a jingle. So for those of you who may not know this, Susan and I did a webinar a couple of weeks ago where we highlighted 21 of my favorite things business owners can do to maximize business value. You can find that webinar on our YouTube channel, which is called, ironically, Maximize Business Value. Today, I want to focus specifically on the things that our listeners should do to maximize their business value in finance and accounting. So I say that business owners should really require and review their financial statements by the 15th. Do you agree with that?
Absolutely.
Why?
Absolutely. Well, because you need information to run a business. You just can't make decisions about cutting costs, managing revenue, setting expectations, really holding people accountable for what's happening in the business. If you yourself as a business owner are not setting up those policies and procedures to ensure your accounting information is being produced timely. So you got to have the information to make the decisions. That's all there is to it.
I'm really alarmed by the number of clients when we first engage that really don't get monthly financials at all. They don't look at their financial statements until year end. You know, a financial statement, in my opinion, is a history book, right? We can't rewrite history. It is what happened. But the earlier that you have that, in my opinion, the faster you can react and potentially make changes that can impact the outcome in the month that you're in. And if you don't get your financials until the 20th, you've got 10 days left. You know, do you advise clients to get them even faster than the 15th if they can?
In a lot of cases, yes. I mean, there's some clients where we're producing them by the sixth business day. So, I mean, it's fast, and it can be, but it really, in a lot of cases, what happens is that you have to have procedures and processes that are not people dependent. They have to be organized and orchestrated in such a way that they basically hum. And in a lot of cases, there's just not a lot of resources that are put into accounting. It's viewed as a cost center, not as a profit center. It really is an opportunity center, as the way I like to think about it. So there really has to be an emphasis on that. And so I think the business owners who dedicate the appropriate amount of time and resources to making sure their accounting is right, they often find the greatest success.
I'm just making a note because I love that. It's not a cost center, not a profit center. It's an opportunity center. I'm going to steal that from you.
All right. Well, I'll send you an invoice for my royalty fees.
Oh, perfect. So, well, yeah, I'll let you know. I'll let you know when it makes it into my next book. You know, a lot of business owners push back on that, on having it by the 15th, because, I just don't have enough people in place. I don't have that. You know, my story is when I owned a sizable business, CEO of a sizable business that had multiple different operating units, our finance team, by the way, our finance team was 4 people. And we were a solid middle market company. I mean, we were very lean and mean, but our CFO produced preliminaries by the 5th, so that our GMs of our different business units could react and ask questions, and finals by the 7th, no later than the 8th, because I needed that data in order to make decisions. And so, and by the way, when I first bought the company, you know, financials were done, you know, by the 20th or by the end of the month, but it's all about just putting the right processes in place. And you can do that if you really think about it and think about eliminating. So even though we're not talking about processes much here today, that is an important point to building value.
It is, and leverage technology. So you're right, you can do it with 4 people. You could probably do it with less now because technology is your friend. So, but it takes an investment of time and leadership to really guide and direct the accounting processes so that they are very seamless.
Very much, very much. So I think that eventually businesses should have their financials reviewed and even audited. That's a hard pill for some business owners to swallow. So first, maybe give us the difference between a review and an audit, and tell us a little bit about the benefits of having the financial statements reviewed and audited.
Sure. So, well, assurance engagements are definitely a lot different than regular accounting services. So when we start talking about assurance, there's 3 levels of assurance. There's a compilation, that's no assurance. It's a review, limited assurance, basically no material departures from GAAP. And then there's an audit, which is full assurance. So these financial statements are in accordance with GAAP. So In a review, the auditor is not necessarily looking for or testing your controls. They're looking for more analytic procedures that are performed. What are the differences between last year and this year? Explaining those changes, especially on the P&L side of things, and on the balance sheet. Really just kind of making sure that everything makes sense with what's happened in the business. On an audit, it is a lot more involved. There's tested controls, there's substantive work that has to happen, there's fraud questions that have to occur. It is a deep dive into, is everything happening in your business the way you say it's happening, and does the documentation prove it? And it is a lengthy process, and it is usually painful the first year, very painful. And you will learn a lot about the things that you're doing right in your business, the things that you're doing wrong in your business, and the ways that you really need to improve in order to have a more successful and streamlined audit in the future. So in terms of benefits, so the review and the audit is great from a user standpoint, especially the larger your company becomes. The users of your financial statements want assurances that the information that they're looking at is right. I mean, I can't tell you the number of times I've received a printout from a client, just a QuickBooks printout, and you look at it and you're like, okay, well, there's negatives in the liability accounts. I know that's not right. I mean, there's all sorts of problems in there. So you know when you're looking at a set of reviewed or audited financial statements that there has been the appropriate measures taken to ensure that to some degree they're limited or full, that the financial statements are accurate. That's what you're after as a user of a financial statement. Is this right? Should I trust it?
So frankly, that's a great point. When you go to sell a business, having audited financial statements, basically is a stamp of approval that these are right.
They are right.
And I think that improves long-term value. But a lot of companies, and I will tell you in some of my own, I've made mistakes like this before. Waited until I had a business doing, $25 or $30 million and very complicated before we decided to audit. And it was like having a root canal every day for 9 months. But the year after that, it was much easier. So I suggest to our smaller clients, look, if you're getting up kind of the $10 million range, you probably ought to do the audit now. It's going to be painful, but it's not going to be as painful as it will be when you're 50 million.
Very true.
And then you got processes in place, right? I mean, does that make sense?
Totally. Absolutely. I could not agree more. I think that really is sort of a magic number, right around 10 million. And it gives you enough room. You don't have the same level of bureaucracy, and you're not as slow. You're a lot more agile still at that revenue level, where you can make those necessary changes and you can move into different, altering those procedures and processes, but yet you have the manpower to make those things happen. So that's a really great number to be at right there in terms of getting an audit.
Excellent. So we were talking about you in your prior answer. You were talking about investing in the right people and making sure you have systems in place. We say that you should never underinvest in your accounting and finance team or your accounting system. Now, I'm going to just go out on a limb here and say that I bet you agree, but when should a company evaluate and reevaluate their accounting system?
Well, it depends on the business. Certainly, I will tell you, anybody who's involved in manufacturing, that has got to be something where if you are starting off, let's say in QuickBooks, and your company is growing probably somewhere around 4 or 5 million, maybe a little less than that, you're probably looking, I need to make a switch to an ERP system. It's unsustainable in a very tiny little program. You're just going to Band-Aid the system so badly, you'll never get it to the information that you need in order to really run things. Or you're going to constantly be making adjustments along the way, and you're just wasting your time. So that would sort of be my recommendation on the manufacturing side. Certainly in other types of businesses like professional services, software consulting, things that are maybe more service oriented, you can last a little longer sort of in your beginner programs. And that might be sort of maybe in the more 8 to 10 million. You might say, okay, I really need to start getting into a more sophisticated way of doing things. You maybe are thinking about job costing, maybe allocation of salaries, you're really starting to think more about the big picture in terms of profitability. And so there's other drivers that are pushing you to that ERP system. So, and then efficiencies as well. And then construction would probably be a whole nother animal because I mean, that job costing from the very beginning is so important. So, and those dollars can get really big, especially for any type of GC. So, I mean, they start off with having really large demands on their accounting systems to begin with.
So I guess that it really depends on the industry that you're in, is what I'm hearing. And
Yeah.
if I kind of read between the lines, it's where your pain points are. If you have to do a lot of manual things in your system, perhaps there's a system that can help automate some of that. And even though it might be an expense up front, it could lower your costs long term. Is that a fair restatement?
Yeah. Oh, absolutely. You know, and a lot of times I'll walk into a client and we've got a CRM sitting on top of QuickBooks. We also have an inventory module sitting on top of QuickBooks. We've got, you've got sort of the payroll piece. I mean, you've got all these different things. And Shopify is syncing. All these different things are syncing into this. It is unsustainable to have that many different types of programs. And I mean, just think about hiring somebody and bringing them on board. I mean, okay, well, let me tell you about the 27 programs we use in accounting. I mean, it's too hard. So at that point, you really have to start thinking, there must be a better way to do this.
Right. So evaluate your system on a regular basis, or when you start seeing those pains. So
yeah.
One of my favorite things that business owners should be doing to improve long-term value is to complete a budget before year end. So look, I've been guilty of this one in the past. I had businesses where many years we were actually doing the budget, sometimes in the second quarter of the year that we were writing the budget for. And I recognize that there are some other schools of thought on budgeting. Charles Koch, in his great book, Good Profits, says that you shouldn't budget, but I disagree with that. Now he runs a multi-billion-dollar international corporation, and perhaps they've got systems in place otherwise. But I think for small businesses, they really should budget. What's your opinion on budgeting?
Yeah, I think it's good for them to actually apply some type of thought to the future, right? I mean, this is sort of probably, to me, this is probably the area where business owners struggle the most because they don't have any time to step back away from the daily emergencies and fires they're putting out to really say, where am I going? And why am I going there? And how am I going to get there? I need to set some goals. I need to set some parameters. I need to have a way to measure what I thought was going to happen versus what I wanted to happen versus what actually happened. So I think it's a good idea to do it. I think for small businesses, it's probably going to be a little looser, maybe not as regimented. It's not going to go through, 8 committees to get to this is what I think the budget should be. But I do think it's a good idea for business owners to be applying some routine thought to the future. Dreaming big time is what I call it. What do I want? And where am I going to apply the resources in my company to get what I want? There should be an ROI to everything I'm doing. How am I going to spend the money? Those are the types of things that the business owner, is directing. They're leading the company to that end. So they should be setting forth the expectations.
I love that. I really think about budgeting time as the time to be reflective. Look, if you've got good growth, you've been growing, 10 or 20, maybe 30% a year, there comes a time when you have to think about, okay, what do we have to do in order to sustain that growth, right? And what things do we need to change? And when you're writing a budget, the top line is the income, the revenue line. It forces you into a strategic thinking process to make sure that you've got the products and services that can deliver another 20 or 30% in the coming year. So I'm hearing that budgeting is a good process. What do you think about business owners? Should they share the budget and hold their managers accountable to a budget?
Depending on the size of the business, in a lot of cases, it just really depends on how big of a business we're talking about. If they don't have managers, they got to hold themselves accountable. So they gotta be looking at this stuff and comparing. But if there are managers who are responsible for certain types of things in their business, like marketing, sales marketing, operations, whatever HR, whatever. I think that they need to be training those individuals and grooming them to take on additional responsibility as their company grows. And the only way to do that is to educate them on the financial aspect of it. So we can never deprive anyone of that understanding of the financial piece of running the business. Otherwise, you're truly not in helping them to help you grow the company.
Yes, I think managers should understand the financials. I used to think about budgeting as a process to make my next year easier because I did have a good management team. And of course, they all participated in the budget process. But we had those discussions and arguments and back and forth and wrangling about how we were going to invest in the coming year before the coming year started. And so we might make a decision that we're going to invest $250,000 in this or $50,000 in that in Q2 or Q3 of the following year. To me, it eliminates all of those conversations in Q2 or Q3. If a manager comes and says, hey, it's time to pull the trigger on the thing we agreed on, can we do that? Well, yeah, we already budgeted. We already had this conversation. So go
right.
And, as long as we're tracking according to our plan, then yeah, it's time to make those investments. Don't bother me.
Right. Agreed. Yeah. Like go ahead and get your job done.
Yeah, exactly. So we're talking with Susan Bryant. Let's take a quick break. We'll be back in 30 seconds.
Mastery Partners equips business owners to maximize business value so they can transition on their own terms using our 4-step process. We start with a snapshot of where your business is today. Then, we help you understand where you want to be and design a custom strategy to get you there. Next, you execute that strategy with the help of our amazing resource network. And ultimately, we help you transition your business on your terms. What are you waiting for? More time? More revenue? If you want to maximize your business value, it takes time. Now is the time. Get started today by checking us out at masterypartners.com or email us at info@masterypartners.com to learn more.
We're back with Susan Bryant, principal with the MB Group, a CPA firm in North Texas, and we're talking about things that you can do in finance and accounting to maximize your business value. So, Susan, so many times small businesses don't take the time to properly recognize, accrue, and relieve assets and liabilities. So, in a nutshell, why should our audience take a hard look at that if they don't do that already?
Because it is impossible to calculate performance without those things. And when we are talking about the value of a business or even running a business, we have to look at performance. Performance is profit and or loss. And so that's why it's important to have accounts receivable. How much money did I earn? So perhaps you have stuff you've billed, but it's not revenues, and you have deferred revenue. So you have to understand how much money you're actually earning and how much money you're actually spending, whether or not you've actually spent it or not, or received the cash or not. So it is important from my perspective to have all those necessary accounting rules in place so that you can truly understand the performance of your company.
And I think to me, it goes back to that whole systems and processes in place. It's not that hard if you set up processes to do this stuff, right? That's my opinion. If you're buying assets, set your threshold and determine if they're going on the balance sheet or if you're going to expense them, and then treat them properly, track everything, make sure it's relieved properly. But one of the keys, especially in small business, is properly recognizing revenue at the right time. I bought a company one time that was invoicing clients when they got a deposit, but it was taking them 60 to 90 days to fulfill that order. And I'm looking at their AR and I'm going, man, this is out of control. What is going on with the AR? Well, no, we bill it, when we get the order. I said, well, I don't think that's appropriate accounting.
Right. That's not revenue.
Yeah, I don't think it counts as revenue until you actually ship the product. I'm not a CPA, but I could be wrong.
Yeah, well, and in a lot of cases, you'd be surprised at the number of times that people are actually billing for things and collecting the money, even if it is a deposit, it's refundable. And so they end up paying taxes on something that they really shouldn't even have to pay taxes on, because on a cash basis, if it's refundable as a deposit, you don't have to pay taxes on it yet. So, I mean, even some other side things. So it's really just a matter of sort of doing a deep dive. And a lot of times when I start working with a client, one of the things we do is we just say, let's go through every process. Let's start with the revenue cycle. You get a customer, what's it look like all the way through? Okay, you get a new vendor, you're buying something new. What's that look like all the way through? You're hiring an employee. What's that look like all the way through the process? So that you are going literally from the beginning to the end, understanding all the different components of that. And a lot of times those things get revealed like, well, wait a minute, that's not quite right. And sometimes the business owner doesn't even know that those things are happening. They're not even aware. They're like, wow, I had no idea that was happening in my business.
Right. Yeah, unless they're
no
so
good.
active. You can't, I mean, the bigger a company gets, the harder it is to be involved in everything, right? You just got to bring in other people, and then things wind up not being the way you intended sometimes. So got to have those processes. So
yeah,
speaking of things that you should take a hard look at, how frequently should a business owner examine their tax filing status?
Yeah, that's well, definitely anytime the law changes to see what is more favorable. I mean, so we have frequent, changes in the IRS, the Internal Revenue Code, and so it's always a good time to look at it when those laws change. Like the 2018 tax reform, the Tax Cuts and Jobs Act, we had the creation of the Section 199A qualified business income deduction, the flat tax, on the C Corps at 21%. I mean, it's times like that where you say, wait a minute, let me take a look at what I'm doing right now. So definitely then. I think that there are a few times. So if you are starting a business, you should definitely look. If you start making, let's say, between $150,000 and $200,000 in net income, that's the time to start looking at it. Beyond that, I would definitely say probably in the $5 million range is when you, at that point, you're saying, okay, I need to be planning for the future. What does that look like for me? Am I potentially going to be taking on some type of private equity? Do I need to be considering some type of C corporation transition? What is the trajectory of this company? Is it I'm going to buy it and sell it, and Tom, you're going to help them do that, and they're just going to take the cash and they're retired? Or is this hey, I think I could take this thing public? What does that look like? And so, I mean, those are different forms or organization structures that really sort of just accommodate each type of business.
Yeah, one of the I love those triggers. I had a great example. I was selling a company in early 2018. We were negotiating it, of course, in 17 when what was the law in December of 17? The Tax and Jobs, whatever.
Yeah, the Tax Cuts and Jobs Act. Yeah.
Tax Cuts and Jobs Act, right? So, but when we were actually selling our business as an asset sale, the good news is we did have NOLs. We were a C Corp, and we had NOLs. However, with that tax law change, it delayed the acquisition because the buying company then reevaluated. They were going to get a tax advantage with the new law to buy stock as opposed to an asset purchase, and it worked out great for everyone involved. But I typically tell business owners that they, certainly during any of those events, they should have that conversation with their attorney and their CPA to make sure that they have the most efficient tax status. But certainly at least 5 years before they're going to transition their business, they should have a hard look at that, because there's something known as a look back. If you change status to get a tax advantage too quickly and then you have a transaction, the IRS can reverse the advantage. Is that right?
That's true.
Yeah. So I say you should look at that at least 5 years before you go, because then 5 years, there's no question. But
Right.
now, and is it? I hadn't really thought about this because you might be surprised I don't spend my life thinking about accounting and tax issues, but it's a big important part of what we do. But is it possible that you may have a more tax efficient method, and you need to change to potentially a less tax efficient method before a transaction because of the big benefit you'll get at the transaction? Does that make sense?
Possibly. So it really sort of depends on the structure of a deal in a lot of cases. So, I mean, like we were just meeting with a client this morning talking about, okay, well, what kind of assets do I have? If I've got a significant amount of, let's just say, accounts receivable and inventory, but not a lot of goodwill, well, that's going to create ordinary income and less capital gains. So, I mean, maybe being in an entity where the ordinary rates are less may be more impactful to me. So, and it really just depends on what I might do with that money in the future as well. So if there's going to be continuing line of business, there's just so many different components here.
All right. Yeah, I knew there wasn't going to be any super easy answer.
But maybe, the thing is maybe, and I will say that probably the thing that fascinates me the most, and something I say all the time is there are so many ways to slice and dice things. We, of course, all within the realm, especially on a tax perspective, of the law, of what is allowable, what is required. But we must first begin with sort of, well, what could we do, right? What do we want to happen? And then we talk about the parameters with which we have to operate. So that's sort of where I like to start is, well, what could happen, and is that possible?
Awesome. Yeah, I start with our clients about halfway through our process of the work that we do. We try to define what is the ideal outcome. And I would imagine that if they could articulate that to you, you could then get more specific about their tax status and how efficient they can be one way or the other if they can articulate that.
Well, I mean, and there's business owners all the time. I mean, we just talk about, whether we're talking about transitioning to sell, even just trying to save money now while we're running the business. I mean, that's an important thing to think about as well. So, which allows cash to be freed up to spend on other things like improving the value of the business, resources, other things that could really accelerate growth and performance. So it's always important to save tax dollars.
So the important thing is go talk to your tax professional, because
that's right.
There could be lots of different ways. Don't be shy. If your tax professional is somebody that you talk to once a year, then maybe you should engage in more frequent conversations, or perhaps you need to go find a new tax professional, someone like the Indie Group. So
right, just call me, I'll help you.
That's right. So one of the biggies that I say for maximizing business value is identifying and tracking 2 or 3 key financial metrics. Now, it's not limited to finance. I think you should have 2 or 3 key metrics in every department: sales, marketing, operations, finance, corporate governance, whatever. Do you advise your clients to track KPIs or key performance indicators? And if so, can you give us a couple of good examples that might be a place to start for our listeners that don't have KPIs?
Yeah, so KPIs are like chicken soup. They couldn't hurt, right? But I think for a lot of business owners, it's really sort of narrowing in on those things that, hey, this is really, this is what I need to know in order. If I was just, the good old 50,000 foot level, what is it that I need to know to make sure that we're on track, right? So I definitely think one of the areas that business owners don't spend enough time is just looking at gross margin. Whether that breaks down by line of business, by product, overall. Gross margin is something that eludes a lot of people. And it sort of goes back to the whole, what do I want to work if I'm not making any money? So top line revenue is only good if you're actually getting profits out of it. So I would definitely encourage business owners to find a way to measure and manage gross profit. That's definitely a big one for me. And then I think it's also important to look at revenue growth rate. I think that's an area where business owners really want their businesses to excel. They are really focused on that. I mean, I can't think of a business owner right now who, you ask them, do you want to grow? And they say, yeah, I want to grow for sure. So I think they've got to have a way to manage that and make sure that they're tracking that and investing the appropriate resources to that end. Now, those are just two. There's a million more, ratios and other metrics that can be used. I mean, and really it boils down to where maybe what the areas that you're struggling the most and where are you excelling the most. And if you're struggling, identifying those ones where you can sort of see progress moving from point A to point B and improvement, and then keeping your eye on the ball on the ones, that are, you're doing well at, making sure they're staying high and not sacrificing to achieve success in the other areas.
Yeah, that brings up an excellent point that is really not necessarily, it's sort of related to KPIs, but I think you should be able to run a financial statement, especially by major product categories and or customers and or sales reps, because one of the practices that is just mandatory, I think, for building long-term value is to figure out what your unprofitables are. What are the things in your business that are not profitable, and eliminate them. Or figure out how to make them profitable. I had a conversation with a client last week where they were really struggling. They've got two major lines. We already know intrinsically, or that one line is just driving everything for that business, and the other line it's not, we don't think it's profitable. We don't think it's doing well. And I just tossed out the idea of what if we just get out of that business? What if we're not robbing the profits from here to put over there? And light bulbs started going off. Oh my gosh, maybe we should really look at that. But the point is that if you don't have a way to measure that, then you can't fix it, right? And so I say look at those things, and that to me is what KPIs are. They are kind of it's kind of taking when you go to the doctor and they're taking your vital signs, right? KPIs are your vital signs. They don't tell you how to fix problems typically, but they can at least point you in the right direction of problems. And so I think that's huge importance. What do you think about doing P&Ls by product category or by customer or things like that?
Yeah, absolutely. And I think a lot of the times, again, it's dedication of resources and creation of accounting policies and procedures that allows you to get that information. So it's garbage in, garbage out. So if you are not taking the time to create a methodology that allows you to produce those types of reports, you'll never see the data, and you'll never be able to manage it to that level of granularity. So you really have to think about what it is you need, what information you need to have on a financial basis in order to guide the company. So that can take various, forms, so yeah, by departments, by divisions, by customers, whatever that is, all those inputs into the accounting system have to be mirrored in that manner. So you get the information you need and you want.
There you go. And you can only manage it if you have the info, right?
That's right. Yes, exactly.
So let's change gears for a second, because I hear from a lot of small business owners that they just hate having debt. That it makes them nervous when they have debt, that they don't like to have debt, even though their business is profitable and well run. While I agree that it's important to minimize debt, don't get over leveraged, right? How do you advise your clients regarding debt and financing?
So I like debt when it's associated with growth, when it enables you to seize an opportunity, when the expected rate of return on the debt is going to exceed the interest rate. So, taking that money and using it in my business is going to do more than it's going to cost me. Now that's a sophisticated calculation and a sophisticated approach. I think one of the other things that, is often not considered, but should be, is that when debt is taken on, what is being purchased? What are we doing with this? Is there a tax benefit? What are the internal benefits? How does it benefit us financially? How does it enable my people to work faster and not as hard? So, I think all those different qualities really need to be evaluated. We're talking about what is the debt going to achieve? So it's not just, I'm going to take out debt. I will always advise clients, do not take out debt and then distribute it to yourself. That's a bad idea.
But that's almost like an easy segue into my next question.
I have seen it, but I would advise against it. So
yeah, when you do take that debt and you wind up with more cash on your balance sheet than you've ever had, don't be a drunken sailor, right?
Right, exactly. That's right, precisely.
So you touched on something that is kind of related to another question I'd like to ask you about before we wrap up here, because we're running long, but this has been hugely entertaining and valuable information. I want to talk for a few minutes about discretionary spending. So most small businesses have some kind of discretionary spending. We advise our clients to relentlessly track that discretionary spending and document it, and at least 2 to 3 years before a transition event to minimize that discretionary spending. So what's your advice regarding discretionary spending?
Yeah, so it's like just stop it. Right, just stop it. A couple things. So first off, I mean, a lot of times I will get engaged by a client and I will take a look at their books, and their business bank account is basically their personal piggy bank. And in my mind, it raises a couple things. So first off, we just got real blurry here on what's business and what's personal. And now we've got to account for it. We've got to take all this time to track your personal spending. I mean, it takes a person time to enter all these things into the accounting software. So you're spending more money to keep track of your personal stuff that you can't even deduct. So just stop it, right? Just quit doing it. The other thing is that, if you were involved in some type of lawsuit and, there could be a perception that it is essentially you as an extension of your business. And so you lose the benefits of whatever corporate protection you think you might have. So, and I'm not an attorney, but that's what all the attorneys tell me. So again, just stop it. Then we get into the conversation about, okay, well, I don't want to pay a lot in taxes. And, I do have to incur all these expenses, to run my business. If I want to, I travel and I got to go check out new deals and I need my card. Okay, I get it. You definitely want to reduce your taxes as much as possible. No doubt. I totally understand that. But if it is muddied and blurred by all the other noise of this personal spending, then what happens is that we're essentially just creating a big mess during a due diligence process to go back and unwind. And it is devaluing the business because now we've got this double-edged sword. We're trying to drive down the taxable income, but we're also actually driving down the actual net income of the company. So I would say at some point, you're just going to have to suck it up and pay the taxes when you're headed into a transaction like this, because it's worth the fact that you're going to streamline the due diligence and get more for your company rather than have to go through and fight over every tiny little transaction because you didn't want to pay 37% taxes on it. So it's just easier.
There's a misperception out there among business owners that, we'll just add all that stuff back, at the end, and that's discretionary and they'll pay me for that. Well, probably not. Most sophisticated buyers are they get what I call adjustment fatigue. Okay, your car, your cell phone, yes. But then when you're tacking on, your lawn service and, at home and your maid service and your blah, 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 they don't believe it at that point. And so you wind up taking a huge haircut on those. Okay, you saved 37% of whatever that was in taxes now, but you just gave up $1 million in value on your business. That's an extreme example, but that's kind of the thing that I think business owners should wrestle with when they're making.
Agreed. Right, and they're taking more risk than they should. I mean, do they really want to risk it? Is it worth it?
Yeah. So and that's right. That is a giant risk. And so there are lots of CPA firms out there, as we know, but I love the MB Group. What should business owners be looking at in a CPA firm, and what sets apart the MB Group?
Well, I think if I was going to be going in search of a CPA, I would want someone who I feel like is an extension of my company, who is truly a partner with me. So someone that I can sit down and I can talk to about pretty much anything that's happening in my business, and that they're going to be a resource for whatever problem I need to solve. So that could be anything from HR to insurance to, I want to sell my company. Where should I go? And, who should I talk to? So really find a CPA who you feel like is going to advise you and be your advisor, not a tax preparer, not a bookkeeper, an advisor to you and your company. So, and that's really what sets us apart. And that's really what I try to do for my clients is, I want them to call me anytime about anything. I want to help them solve those problems in their business, whatever it is. So anything from creating a budget to, I need the KPIs. My staff just quit. I need somebody to do the accounting. Okay, great. I think those are the things that I think that set us apart and the things that we endeavor to be for our clients.
Awesome. And I couldn't agree more. I've talked with many of the MB Group's clients, and it is a resounding thumbs up that as I started this podcast, I said that you really want a CPA who acts as a surrogate CFO. Even if you have a CFO, my CFO in my last company was very dependent on our CPA and would turn to our CPA frequently for advice, right? And so you just really want that, somebody who's looking out for your best interest. So one last question. This podcast is about maximizing business value, and we've talked about a lot of things. What's the one most important thing you recommend business owners do to build long-term value in their business?
Get off of autopilot. So look at everything in your business. Look at where your money is coming from. Look at where your money is going. Look at your customers. Look at what you're doing. Look at systems. Be relentless in constant improvement. Self-introspection about where it is you're going and what it is you're doing, and get off of autopilot.
I love that. I've recently been in discussions with a prospective client that's doing lean manufacturing, and you boil it down, and lean is about continuous improvement, right? Continuous improvement. And I love that. I think that is great advice. But you also know, if you listen to our podcast, and our listeners know this out there, that I always ask a bonus question right after I tell you I've asked the last question. And that is, what personality trait has gotten you into the most trouble over the years?
Ooh, boy. Well, I am far too outspoken. So, and I always tell people, if you ask me for my opinion, I'm sure to give it. So,
yes.
But that can result in problems.
Awesome. Well, I love that. I love that about you. So how can our viewers and listeners get in touch with you?
Yeah, so I would love to hear from your listeners and viewers. You can call me at my office, 469-865-1040, or you can email me at sbryant, that's SBRYANT, at mbgcpa.com.
Awesome. And you guys have a website, mbgcpa, correct?
.com. You got it.
So thank you, Susan. This has been a lot of fun today. Thank you for being our guest. You can find Susan Bryant at mbgcpa.com, or you can also find her on LinkedIn. And of course, you can always reach out to us at Mastery Partners, and we will be happy to put you in touch with her. This is the Maximize Business Value podcast, where we give practical advice to business owners on how to build long-term sustainable value in your business, even during challenging times like these. Be sure to tune in each week and follow us wherever you found this podcast, and be sure to comment. We love comments, and I promise we respond to all of them. So until next time, I'm Tom Bronson, reminding you to look at your accounting systems, think about your relationship with your CPA while you maximize business value.
Thank you for tuning in to the Maximize Business Value podcast with Tom Bronson. This podcast is brought to you by Mastery Partners, where our mission is to equip business owners to maximize business value so they can transition on their own terms. Our mission was born from the lessons we've learned from over 100 business transactions. which fuels our desire to share our experiences and wisdom so you can succeed. Learn more on how to build long-term, sustainable business value and get free value-building tools by visiting our website, www.masterypartners.com. That's mastery with a Y, masterypartners.com. Check it out.
That was perfect. I wouldn't make any changes on that.